The halfway point of 2024 is almost here, and so far markets have been on quite a run. The S&P 500 is up more than 14% year to date, the Nasdaq up more than 18%, and both have been hitting record highs. Much of those gains have been driven by mega tech stocks, but that hasn't been the only driver. Joining us for a look at what he is watching is Benjamin Gossack, Managing Director and Portfolio Manager with TD Asset Management. It is lovely to have you here.
Thanks for having me back. It's been a while since we chatted, and I'm looking forward to it.
You've got lots of good stuff here. So let's start with the first chart that you brought. And you say that while there has been market breadth, despite these mega tech stocks doing so well, people tend to forget there has been, the market breadth is narrowing.
Yes, so a few things. We are pushing to new highs. The push to new highs, the breadth has narrowed, but I would argue that we're in the midst of a 2-year bull market. I think we're approaching the 2nd year anniversary around summer. And there have been periods of time where we've had, large parts of breadth and then narrow parts. We're in that narrow phase. But one of the reasons, and it's a chart that I brought, one of the reasons why we have never really bought into this sort of 7 stocks driving the market, that doesn't give enough credit to this market.
And tell me how that shows up here.
So let's say we take the 500 stocks in the S&P 500 and we count green days versus red days for all the 500 stocks. So if you're green, you get 1 point, and if you're red, you get -1 point. And then we just keep a running total every day. And so you can see, and I took it back to kind of the summer of 2022, which is when we think this bull market started. Okay. We've had more green days versus red days across the 500 stocks. If it was just 7 stocks versus the 493, this would be a much different chart. What you can see right now in the current phase, call it April, May, June, is that it's been going sideways. So yes, we've been pushing to new highs, but the number of winners have been balanced by the number of stocks that have lost. So again, I would say we're in this consolidation phase right now.
Fascinating. Second chart we've got here is taking a look at market breadth and number of members with new 52-week highs and lows. So again, what's material about this chart?
So if we're in a bull market cycle and we're breaking to new highs, we'd like to track the percent of the companies in the index that are making new highs on an individual basis. And so there have been periods where we see lots of companies making new highs, and then all of a sudden we don't see that as much anymore. And so there was a brief kind of spurt in May, in June. It's been kind of narrowing. So the index is making the new highs. The stocks that are contributing to those new highs individually have started to fall. But more importantly, what stands out to me is that, yes, we're having some consolidation. The stocks that are taking the market higher are fewer and fewer, but we're not seeing a lot of stocks that are making new lows. And that's the blue on the bottom. So again, you can't have a sell-off unless stocks are selling off, and we're not seeing stocks sell off. So I just think it's just another phase of this bull market cycle.
Yeah, it's great data versus the narrative sometimes to see that, huh?
Yes, and so, look, we run very busy lives, and then when you're told it's 7 stocks and you don't have a chance to check, then you say, okay, the smart people on TV are saying it's 7 stocks. Or you're told that equal weight is behaving a certain way, and that's a story for another time, but I don't think that's market breadth. So there's different ways that we like to examine the market just to see, our version of what market breadth is.
Okay, you've got some more here. We're going to take a look at what's going on. You've got some specific sectors that you've pulled out as well. This is technology and financials we're about to look at. Tell me, this obviously, what are we looking at here? A 6-year look. Tell me why you're looking at it this way.
Okay, so for the next couple of charts that we're going to look at, I took out the top 6 sectors of the S&P 500. So that would represent 85% of the market cap of the index. So that's a pretty good picture of the index. What we're looking at here, and I'll spend a little bit of time on technology and it'll make sense for the rest of the charts. We like to understand if our sectors or our stocks are pulling the market higher or falling behind the market. And so the way that we like to do that is in the form of a ratio. So what you're looking at, Kim, is a fraction. The numerator is the tech sector of the S&P 500 in this fraction, and the denominator is the S&P 500. And so your eyes are doing all the work for you, which is it's been up and to the right, and I don't need to convince you that it's been a technology-driven market. So if you've owned technology, you've outperformed. What I would like to highlight for people is that peak that we saw in, it would be like around January, for most of this year, technology has actually been an underperformer. It's only in the last maybe month and a half that we've seen technology lift.
Back up again, yeah.
Exactly. Whereas people would say, look at the year-to-date performance of technology. It misses out how did we get there. We've seen clearly the AI chip stocks outperform. We've seen hardware tied to that. But software continues to underperform since January. So it's not just all technology. There's certain parts of it that are working.
And then for the financials, we see the opposite trend.
Yeah, so we've seen that kind of just been underperforming. There was a brief period of time in November of last year when Jerome Powell, the Fed chairman, says we're going from hikes to cuts, and we saw a liftoff in the banks. That's tied to people being concerned about provisioning for credit, but we've seen that kind of roll over. A lot of it driven by, again, the regional banks. Still, large cap banks like JP Morgan still outperforming, private credit outperforming, insurance outperforming. That is a stock picker sector.
Okay, let's take a look at healthcare and discretionary too. These are fascinating to look at this way. So healthcare has been volatile. They've both been volatile, I guess. Yeah.
Yeah, and so the story for 2022 would have been healthcare. Up and to the right, almost the entire year. I'm sure most people in their portfolios would have been in healthcare. And then with the exception of maybe the companies like an Eli Lilly or a Novo Nordisk, most healthcare has just been a serial underperformer. A lot of it has been driven, there's still a destocking period of all the inventory that was built up during COVID. Like, that's still not done. We think we're in 2024, but that's still an overhang. I also think there's also an existential crisis going on. Lots of companies built up these franchises, but some of these obesity drugs are sort of challenging that terminal value. If I do lose weight, do I need that dialysis machine? Do I need that sleep apnea machine? So I still think that is working in the sector. But clearly, if you own a healthcare stock and you're like, why am I not keeping up with it? That chart's telling you it's just not keeping up with the rest of the market's underperforming.
And the discretionary piece was volatile as well, and actually, but holding up better than I thought it would have, given the narratives we hear about the health of the consumer. And
because with that chart, I made a slight tweak.
Okay.
If you look at market cap discretionary, it's so dominated by Amazon and Tesla that you miss the entire picture. And that is a feature and a problem with the indices that we have. They're just obscured by these large companies. Discretionary was incredible last year on an equal weight basis. It is less so. Travel is still doing well, but there are areas of this market where companies were able to raise price and can't raise price anymore, and the market is acting accordingly to those stocks, and they're taking them down.
Interesting. Okay, last one. We got about a minute. Communications and industrials. Again, we'll take a look at. That's quite the dip. What we're seeing at the end of 2022, which makes sense given what was going on, but industrial is really seeing something very interesting there too.
So then let's just focus on the industrial part.
Okay.
Yes, the focus has been on technology. So the industrials, and again, we had to do a little twist here. This is equal weight. You can't see this on a market cap basis, but they take off in March of 2022, which is the exact same time when the Federal Reserve begins its hiking cycle. Yet industrial stocks are taking off and outperforming this market. So many mega trends going on in industrials, whether it's decarbonization, electrification, they benefit from the data center expansion.
Bringing things home at the same time.
To me, this is the chart. I believe that industrials are the generals of this new bull market cycle. And so yes, there has been all this focus on AI and semiconductors, and yes, we're focused on there too. But do not lose sight of these industrial companies.
We've got a couple more charts that you brought with us. And the first one talks about the amount of cash and I guess cash on the sidelines.
Yes. So we talked about being 2 years into a bull market. This phase feels a bit narrow in terms of the stocks that are driving it. We talked about how tech is kind of working. We showed you a whole bunch of other sectors that are underperforming. So the question I always get is, so how long can this cycle last? I think most people actually haven't participated in the equity markets.
Which is amazing, given where the markets are.
Exactly, but we've had a lot of people on the sidelines with cash. A lot of people felt comfortable earning 4 or 5% on their GICs or short-term paper. What you're looking at here is the S&P 500, which is, I'm going to use as a proxy for risk assets relative to cash levels. The number that you keep hearing in the news is 6 trillion for money market, but that includes institutional money, and we're really focused on retail because institutions may have derivative contracts on top of their cash. So it may already be in productive use. And so the thing that we're focused on is that at market bottoms, that's typically where you see a cash peak. People lose money, don't like it anymore.
At market bottoms.
And they raise the last dollar at market bottoms.
Right.
And so we are still approaching, peaks in the levels of cash while markets are already pushing now to new highs. And so again, it just tells me that so many people are outside of this market. And we will have 5% pullbacks, 10% pullbacks, but my expectation is that those pullbacks get bought with the cash on the sidelines.
That's just, it's fascinating. Is there anything fundamentally that's changed in the markets that has the markets act differently? I'm sure there's actually a long list, but when you see these high cash and peaks in the market at the same time.
I think the levels have changed, but the relationships, the correlations still, to me, look intact.
Okay. Next chart you have is showing the gains on the S&P 500 and the reaction by investors. So tell me what we're seeing here.
So we think that we've been in this two-year bull market that started in the summer of 2022. But I was out going cross-country as late as November when it looked like the market could roll over, people being very happy with cash. And then all of a sudden, the market starts to take off in November of 2023, faster than people liked, probably because they were still sitting in cash. And then the market continued to go higher. The message here, Kim, is not to time the market. You don't have to follow my process or anyone's process, but just follow a process. Because oftentimes what can happen is we're going to look back on 23 and say that was a great year because the S&P was up 26%. Well, you got that in a 2-month period. So my message to everyone is follow a process and then to not try to do this thing called timing. So yes, there is a lot of cash on the sideline. Talk to a professional. Make sure that you're working on a plan. But this timing thing, we don't even think we're very good at it. But we follow a strict process, and that is what helps you with situations like this.
It's so tricky though, because if someone sees this chart when they see it, and my honest reaction too is I look at it and go, geez, the market is high. Like this seems like maybe absolutely not the right time. But probably someone felt that same way back in November and felt that same way before too, right? And that's just the hard part where you just don't know, and especially with all that cash on the sidelines.
Exactly.
Yeah.
And the last thing you want to do is put that cash in and then see it fall down 10%. So there's so much human psychology that goes on. And when you stick to a process, then that takes away. Oftentimes it's just you versus the market. And yeah, you're the author of your underperformance.